We're in an AI bubble, and the bubble will burst. That will result in people losing their jobs and filtering through to the everyday economy.
We are at the biggest technological platform shift the world has ever seen. So we're just getting started. We're not in the bubble. This is the most exciting time to be alive.
This is Open to Debate. I'm John Donvan. Hi, everybody. We have been doing debates about artificial intelligence for 10 or 11 years, back when the moment that we are now in seemed like some kind of fantastical, thrilling and chilling at the same time future of very, very far off reality, if it ever did become reality. Well, here we are. It's reality. It is happening. Yes, it's thrilling and chilling both, and it's moving faster all the time. And part of the mood that we're in right now, if you feel it, is the fear of getting left behind for things like jobs and education. And quite interestingly, for people who are in business. Right now, it feels like it's the bandwagon everybody's jumping on. Every company is jumping on AI. They're all, as they say, leveraging AI. And it's not just a PR move. The business world is investing unprecedented amounts of money into artificial intelligence. And the firms that are closest to laying the AI infrastructure, like Google and Amazon and OpenAI and Meta, they are laying out hundreds of billions to pay for research and to construct the data centers that train and run the digital machinery. And it's not just because they fear getting left behind, but it's also because the financial payday that is anticipated, the money to be made from AI, is going to be, it is said, I'm not going to be fantastical again, but it's really, really huge. And if you're someone who is trusting your financial future to these companies by buying their stock, or if those stocks are in your 401k, again, it's going to be great if this ship comes in because your retirement will get a lot more comfortable as a result. If that is you, in fact, the last couple of years have really been encouraging. You have done well, at least on paper. But is it too good to be true? Or a more analyzable way to put it, has it all been too much too fast? According to an MIT study from last year, 95% of generative AI initiatives are not profitable. So there is talk of an AI bubble, and bubbles are never good. By definition, bubbles happen when perceived values get way out of whack until reality finally hits, and then companies go bust or stock prices fall, and the hopes and the money both disappear. Bubbles are not about the eventual usefulness of a technology in the long term. They're about a specific moment, that moment when the expectations for the profits have outrun near-term reality. Are we in such a moment now with AI? Or do these companies really know what they're doing? Let's find out. Here's the question we're going to debate. Will the AI bubble burst? I'm happy to say I have two great debaters with me. First, arguing that the AI bubble will burst, I want to welcome Ryan Cummings. Ryan served as an economist at the White House Council of Economic Advisors under President Biden, and from there he went on to be economic advisor at MIT and is now chief of staff at the Stanford Institute for Economic Policy Making. Welcome, Ryan. Thanks very much for joining us on the program.
Thank you for having me, John. Really excited to be here.
And we are excited to have you, as we are your opponent. So I want to welcome the opposition coming from venture capitalist Magnus, Grimeland, the CEO and founder of Antler. Antler is an early stage investor with a large roster of AI startups. Magnus formerly worked at McKinsey and is now based in Singapore. Thanks so much for joining us, Magnus.
Thank you for having me. Very excited to be here.
So Ryan, you get the floor first. We're going to give you 4 minutes to tell us why you are arguing the yes, that AI, the bubble, will burst. The floor is yours. Please tell us why.
Thank you so much. And it's a pleasure to be here with Magnus as well. I think AI is a technological revolution that's going to change the productivity of firms and workers and has not only already changed our daily way of life, but will continue to do so increasingly in the future. I think AI shares that quality with previous technological revolutions. A lot of listeners will be familiar with the railroads in the late 19th century, the rise of electricity in the turn of the earliest 20th century, and of course, the internet revolution that just happened decades ago. All of those technological revolutions, just like I believe AI will eventually, ended up with a bubble that burst. And I believe we're in a bubble and it will burst for two reasons primarily. The first is if we think about the amount of profits that are expected to accrue to firms, as John very well said succinctly up top, are extraordinary. And not only are these profits estimated to be upwards of trillions of dollars, but also they're expected to accrue to investors and individuals rapidly fast, much faster than we typically see through technological diffusions of anything in the past. The other component of why I think we're in a bubble is because of the firm's valuation that they're receiving just because they're related to AI, or as I like to say, they have an AI valuation fairy dust sprinkled on them. And what I mean by that is, again, with each technological revolution, there's always a narrow, concentrated set of winners and a much larger pool of losers. And it takes time to figure out who are the winners, the firms that can harness the full value of the technology to reap outsized profits. And who are the losers, the firms that cannot efficiently and effectively use the power of the technology. But right now across the stock market, what we're seeing is sky-high valuations for not only the AI firms themselves, the hyperscalers and the firms that are building the large language models like OpenAI and Anthropic, but also for companies that have simply pivoted to AI and say they're integrating AI into their workflow and that they're going to use AI to become even more profitable than they are. So just to give some concrete numbers, for example, the S&P 500 has a current price to earnings ratio, which effectively is the stock market's valuation of $1 of profit, of 24. It hasn't been that high since immediately before the dot-com bubble burst. And we're seeing this again, not just very high valuations for firms like the Mag 7, the 7 group of firms which are very large AI investors, but again, for firms that have ancillary exposure to AI. So for example, not even just software companies, but large retailers who say they're integrating AI better into their sales forecast. Now, to the point of the timing of the profits too, we're seeing a lot of the valuations are expecting revenues, for example, in the case of OpenAI, to increase by much as 17x in the next 5 years. And that's already on a base of OpenAI just announced they're making around $20 billion. To increase your revenues from $20 billion by 17x in 5 years would be extremely ahistoric. That would be something that we've never seen before. So to conclude, I think that we are in the middle of a technological revolution, but I don't see the story of this technological revolution having a different ending than ones before it. I think it's going to take time, decades, as is often the case, for AI to diffuse throughout the economy and also for the market to sort out who the winners and losers are going to be. Until we reach that point and markets start to realize that the profits are not going to accrue as fast as has been promised, or that there'll be many more losers than there are winners, we're in an AI bubble. But once the market does realize this, I think valuations will come down and the bubble will burst, or alternatively deflate over a longer period of time, which is what I believe we've been seeing since October.
Thank you very much, Ryan. Magnus, the floor is yours now to take the opposite position. You are, the question again, will the AI bubble burst? And you are saying no. Your turn begins now.
Excellent. Great to be here and great to be here with Ryan. I have a ton of respect for the work he's doing. To start off, I think that when you look at past technological shifts, they've led to a lot of value generation and productivity increases, and don't always come with a bubble. So I want to kind of argue that that is not what's happened. If you look at the computer platform shift, the personal computer didn't really come with a bubble. If you look at the mobile platform shift, didn't really come with a bubble. If you look at the cloud platform shift that happened over a long period of time, we did see it with the .com platform shift, the internet platform shift. But there are major differences between that platform shift and what we're seeing today. And the reason why I don't think we're in a bubble are really those differences, right? So number one, we live in a world now with real usage of AI that we never saw in previous technology shifts. If you look at B2B, for example, with the cloud platform shift, it took decades before the cloud was in the boardroom and on the agenda of the world's largest companies. With AI, very early on, we're already at about 80% adoption in large enterprises, somewhere in the business. And B2B are talking about this at the same levels as customers. If you think about B2C, almost all your friends will be using AI in one way or another. And it's a little bit similar to earlier platform shifts where it's as kind of compelling to really young people as it is old people. So you see a tremendous amount of real users adoption in a way we've never seen before. Two, if you look at the capital spend, the capital spend is really related to real economic demand, right? There's more demand out there now for computing power, for chips, for power, and a lot of other areas. And we have a supply shortage. So the capital allocation is actually it's falling behind the demand and not the other way around that you've seen in some of the previous platform shifts. The growth we're seeing in the companies is unprecedented. I do agree with Ryan that some of these growth plans are very, very ambitious, but you're actually seeing that is reality. Like if you look at OpenAI, they grew their revenue almost 10x in a year. If you look at some of our portfolio companies, they're growing even faster. And these are real companies using their technology to drive real efficiency gains. So we're doing real revenue growth. The fourth point I want to make is that we're already seeing measurable ROI for enterprises and businesses at the level we haven't seen in previous platform shifts. We see for certain workflow somewhere between 20 to 60% efficiency gains. And we also see that AI is becoming a pretty large part very quickly of enterprises' software spending. The fifth point I want to make is that this is a general purpose technology, right? It's not like some of the previous platform shifts where it took decades before it could touch different industries. We're seeing adoption across industries at a level we've never seen before. So in that way, it's much more like electricity or the cloud than some of the other platform shifts we've seen. I think the sixth point I want to make is that we are still very early on in this journey. We're definitely not at some sort of peak. So I think we'll continue to see a lot of investments going in here and revenue growth over the next decades, which is not akin to a bubble. And for sure, I want to acknowledge that there will be some losers. Like whenever you have this big platform shifts, not everyone will win. And there are companies out there that are overvalued. But in general, I strongly believe we're not in a bubble.
Thank you very much, Magnus, for your opening statement. Thanks to both of you. I just had a question about relevance for people who are not specialists in investment. The people who will say, I never even touched ChatGPT in my life. What does that have to do with me? Ryan, you go first. And I'm looking for just a very short answer. Why should somebody care about this?
Simply because if the stock market is heavily valuing this and the stock market goes into a recession or goes south very quickly, that's going to have impact for everyday Americans. So a stock market is called a leading indicator, meaning it goes south before the rest of the economy. So if there's a big bet on AI that the stock market's making that doesn't pay off, that will result in people losing their jobs and filtering through to the everyday economy. And Magnus, how about you?
Well, I think one should always have a balanced portfolio, right? And I'm a venture capitalist, so I'd like that people invest into technology and innovation, but I wouldn't advise that everyone put 100% of their capital into technology, right? But do I think you should put 5 to 20% of your capital towards probably the biggest technological shift in human history? Yes, I firmly believe that, and believe that in the long term it will lead to a strong portfolio performance on top of everything else you back.
All right, thanks very much. I want to take to you, Magnus, your opponent's point that history just, you made the kind of pushback on history argument. Why you are fundamentally saying what people say in all bubbles. This time it's different. Why is it different this time?
Well, so I went through a list of kind of 6 reasons why I think it's different this time. Fundamentally, we are seeing an adoption that we've never seen before. And the argument I made in terms of past bubbles is that if you look at a lot of the bubbles in the past, right, they're actually not necessarily tied to a technological shift, right? So the financial crisis had nothing to do with technology. It had to do with financial instruments and over-leveraging on mortgages. So sure, the dot-com was a bubble that affected everyone. I think if you look at the blockchain bubble in 2018, 2020, 2021, it affected some people. But typically these things are, these bubbles are created when when technology moves faster than demand. And I think literally we're in the situation now where actually demand is moving faster than technology, right? And so actually there's more demand out there for this technology than the technology is able to serve. Also on the infrastructure side, right, there are huge supply chain gaps on chips, on energy, on data centers. And in these types of situations, you just tend not to generate the bubble. And with that said, we're just getting started. Like the problems that AI is currently solving is mostly around kind of knowledge, creating efficiency around versus processes and so on. I think we're moving into a period of time where AI will help us solve problems we haven't been able to solve before. And that, I think, will start to unlock a whole new level of value creation, right? If you think about healthcare, for example, healthcare is a very exciting area, I think, for AI, where you're starting to see now you have the first antibiotic ever created by an AI engine, created faster than...
Well, Magnus, let me just jump in, because I want to develop those points that you're making there, but I want to let Ryan respond to some of what you're saying. Fundamentally, this time it's different because you're saying that the demand is greater than the supply at this point. That's a very, very different dynamic than we've seen in the past. Ryan?
Yeah. So Magnus is obviously talking about, for example, the demand for compute and building data centers and things like that. That's not necessarily the demand from the ultimate end users. So to make a little bit of a ridiculous example, it'd be like if people were trying to sell Labubus and there was huge demand for the construction and the factories, and everybody wanted to have a factory that could produce as many Labubus as possible. But at the end of the day, if consumer demand for Labubus isn't high, that might turn into a bubble. I think we did experience a Labubu bubble that's now popped. So in that sense, I think there is a very high demand for creating the supply. But the question is that supply CapEx? So for example, we've seen the top 4 firms, I believe in the next year, are planning to spend over $600 billion on CapEx, primarily AI-related CapEx. If there's not a corresponding revenue side, and they typically think about these investments in 5, 7, maybe 10-year horizons, if there's not a corresponding revenue side that's even greater than that $600 billion over the course of that investment, then it's going to look like we overbuilt in some sense. The other point I want to make is about the adoption. So certainly agree with Magnus. We're seeing incredible adoption. Everyday people are using...
Before you get to that, just so we can break this into little pieces, remember that thought you wanted to ask about adoption. I just want Magnus to respond to what you just said.
Yeah, so I agree. It's unprecedented CapEx investments, and I guess the question Ryan is asking is, will revenue follow that investment side? And I guess where we disagree is that I believe it's already doing so. Right? If you look at the biggest companies within AI right now, they're growing at the rate of almost like 10x per year. Now, obviously, that growth rate will go down as they become bigger. But
you're talking about the growth of their value,
the growth in their revenue.
I just want to be clear.
The growth in their revenue.
Okay.
And I think this is very different from, like, I think whenever you see, as you're building up to a bubble, you then tend to see like growth in valuations happening, but you don't see the corresponding growth in revenue. And I think that's what's different this time. And the other major question around adoption, which we started talking about, is that big platform shifts tend to be led by consumers. This time around, I think it's actually led by B2B at the level we've never seen before. During the cloud platform shift.
Can you just for the person who doesn't have this language in their back pocket, explain B2B and consumer and the difference?
Yeah, so typically when there's new technology coming, consumers are quicker to adopt it than companies and businesses because they tend to be a bit more conservative in their decision making, and processes tend to take a longer time. But consumers are like, they like to try things, see what happens, and so on, which is very often like consumer leads these big platform shifts. In this case, it's actually moving more or less 100% in parallel, right? You go to any major company today or small business today, AI will be on the agenda of every single management meeting, every single board meeting. And they're willing to spend real capital at using AI to drive efficiency and build new products. And
is it a smart move is that a smart move on their part?
Well, it's paying off, right? It's showing that you already have within certain workflows 20 to 60% efficiency gains, and then we are not yet even seeing it being applied to growth, right? It's mostly now used to improve efficiency and give more leverage to employees. And we haven't even started seeing like how to use this to drive growth in new products, which is what I was getting into around healthcare.
Yeah, and I just still want to get back to that. But Ryan, you were going to go to adoption, but I think that's what Magnus is talking about, is that many businesses are saying this is what we have to do right now, and they're doing it. So that goes to the adoption point.
Yeah. So this is kind of part of the timing component. So there's, for a technology that's a general purpose technology, as economists would call it, it's being diffused widely throughout the economy and every sort of business, which again, I believe AI will eventually do. There's two components though. The first is the adoption. And then the second is it's not sufficient just to say, okay, I hooked up my factory to electricity, or all my computers now have the internet, or now I'm using AI. But you have to figure out how to best use it for your workflow. And that in particular takes a very long time. So it's not sufficient just to adopt it. And even then on the adoption, the St. Louis Fed, for example, has a survey looking at how many work hours were spent using AI. And they did this in late 2025 and found it was a little greater than 5% of work hours in firms were using AI, which means 95% of the time people at firms were not using AI. Now, again, maybe in that 5% of the time they were extraordinarily productive, and I anticipate this number will increase further as time goes on. And you can look at different surveys from different firms. The Census Bureau has one, the BOTS survey, and it shows around 17 to 18% of firms are using this in some sort of core business capacity. But again, that means 80% are not. Even among Americans, there was a Pew poll that asked in the last 6 months, did you use AI? And roughly 50% said they did not even use it at all in the past 6 months. So it's the speed of adoption here, which is really, I think, what Magnus and I are debating, because both of us agree it's eventually going to be adopted everywhere. And if you don't have that fast adoption, you're not going to have the profits accruing to the firms making these heavy investments.
Yeah, so I think if you look at the data, like 80% of businesses are using some AI, and I think if you take the 5% number, I think it's probably a little bit higher than that. But if you take the 5% number Ryan puts out there, assuming 5% of all the work hours in all businesses in the world are spent using AI, and we're only like a few years into the AI platform shift, and you think about how big that economy is, that's already pretty huge, right? And that leads me to the reason why I think we're not on the bubble, because like all of these things are really, really real, right? And I think another great example in parallel is if you think about Zoom, like obviously now we're talking on like similar environment as Zoom. The way Zoom became adopted globally, or video conferences became adopted globally, was not by some CEO or chairman deciding, hey, everyone should use video instead of phone conferencing. It was literally workers started using it themselves because they saw that it drove efficiency in their firm, right? So Zoom actually, they sold kind of bottom up. And you're seeing the same thing happening, I think, across AI technologies where employees of these companies are discovering how to use AI to improve their businesses, and they start experimenting around it themselves, and then they convince the leadership to implement that in their processes. And I think that's an even more sticky way of creating adoption, when the people who are actually working in the company themselves are so excited to use the technology that they can't live without it, and they convince their bosses to invest into it.
Ryan, do you have any concern at all about the accounting that these companies are doing? You know, I'm not saying funny money, but do you think the numbers are strictly legitimate, that in fact these revenues are real? And not, this is a separate question from whether they're going to keep growing, but Magnus has made the case that already it's damn impressive what these companies are doing. Do you trust the numbers?
Yeah, I don't think there's any sort of wide-scale Enron type of fraud happening. At the same time, though, if you look at something like OpenAI, for example, they are the fastest company ever to $10 billion in revenue. Now, the issue with having this kind of explosive growth, which the valuations are trying to justify right now, is that marginal dollar in revenue is much harder to come by as the firm gets larger. So just again, to make a simple example, if I go outside, it's almost 90 degrees today in Palo Alto and start selling lemonade, the first $100 I can sell in lemonade is probably going to be pretty easy. But if I want to scale that, for example, to increase that by 17x and make $1,700, that marginal dollar is going to get much more difficult. The other component, too, is there is concern about whether or not they're accounting for their chip expenditures correctly, on whether or not they're writing that off over 7 years and it should be 2 years. I don't have strong views on that. But more broadly, in terms of the revenue that's accruing from AI, I think the firms themselves, again, are trying to figure out how much is actually coming from AI versus existing processes. So I've spent a lot of time actually looking into this for the 4 biggest, quote unquote, hyperscalers. That is the firms that are building all the data centers. So Google, Microsoft, Meta, Amazon. And it's difficult for them to even tease this out because, as Magnus said, if you're a software engineer, for example, and you're using AI and you're improving code that was already written by not AI, how much has that improved? And if you look at the company earnings and transcripts and what they say their AI earnings are, you could probably say they're upwards, maybe per firm of these 4 firms I mentioned, of somewhere around $20 billion is probably the most kind of direct AI-related revenue measure. Again, that has to be contrasted. And $20 billion is, of course, a lot of money, but that has to be contrasted against how much they're spending. So, for example, if Microsoft is going to spend $150 billion this year on AI CapEx and they're only making $20 billion, that means they're going to have to make way more in the future. And that gets increasingly difficult as the amount of revenue that you need gets larger.
Yeah, that is the thrust of your argument. Magnus, can you respond to that? And I know you've been wanting to talk about healthcare. Perhaps you can use healthcare as a part of your response to that question, to that point that Ryan is making, that these companies are, the amount of money they're going to need to justify their expenditures now is enormous. So what do you take of that? What do you make of that?
So I already touched about it. So basically we're seeing the unprecedented revenue growth, and we're actually seeing that they're delivering on their predictions. They're actually over-delivering on their predictions, the best companies out there. I do think what is important to take into account is what I also spoke about in my opening argument, is that as you're assessing these companies, there will also be losers, right? And I think as you look at revenue growth and you look at revenue within AI, it's very important to look at where do you believe you have sticky recurring revenue versus experimental revenue. Because as I agree with Ryan's argument that selling the first $100 of lemonade is the easiest. Now, where you build conviction in specific use cases and where you can, I think, determine whether you're investing into a winner or what will be a loser, independent of whether this is a bubble or not, which I don't believe it is, but there will be losers. You need to look deep into that revenue and kind of figure out, how is it generated? Where is it coming from? As the revenue grows, is the gross margin increasing or decreasing? Are you becoming more profitable or less profitable as you grow? What does the unit economic looks like? So I think the devil is in the detail there in terms of asserting whether the quality of the revenue is there and determining which of these companies you should back versus which will probably end up becoming the losers. So in terms of healthcare, I think the interesting part there, I think, is obviously healthcare is the fastest growing spend category in the world right now. It's also where the marginal effect of another dollar being put into the healthcare system in the US or other places is very, very low. And we're quite excited about the efficiency that AI is already starting to generate across the healthcare sector. But what I'm most interested about there and what I want to get into, which I think is the really a much bigger part of the revenue generation you'll see from AI than what you've seen so far, is kind of the solving new problems, right? So far, a lot of the AI efficiency gain and productivity has come from improving existing processes, like doing it more effective, giving leverage, which is great, right? You just making more people more effective, you get more things done cheaper. But within healthcare and a lot of other areas, you'll start seeing AI coming up with new diagnoses, coming up with new medicines, new vaccines, early detection, which allows you to avoid a lot of things people are dying from. Like 92% of global healthcare spend is currently spent on treating diseases, where 80% of it could be avoided by early detection or simple changes to lifestyle. And I think it's just a great example of how we haven't even started kind of really tapping into the biggest potential of AI, which are working on solving these things we haven't been able to do yet as human beings. So far, we're just focused on the productivity part of it, which is amazing and is driving already a lot of revenue. But we're we're very, very early on this platform shift.
One thing that you talked with us about a little bit, Ryan, when we were talking with you before the debate and about doing this debate was the issue of circular financing, which some of the Silicon Valley companies are involved in. Is that still a concern of yours? And could you explain what it is?
Yeah, so circular financing is roughly where one firm makes an investment in another firm, who then in turn is going to take that investment and reinvest it into the firm. And so you have this circle of financing, hence the name circular financing. So
that would be like if I set up a lemonade stand on my block and then I went around to every house and gave them $1, and then they came back and they bought $1 worth of lemonade from me with the $1 that I gave them, but I would say that I had made $1 from each person. That's kind of the concept of circular financing?
Yeah, basically. So a concrete example in this space is NVIDIA was going to make an investment in OpenAI. And that investment in turn was going to finance OpenAI by buying more NVIDIA chips. Now, this isn't necessarily from first principles a large economic problem if the profits, for example, are going to go up. It's just changing how they're financed and then who gets them. The issue with circular financing is it makes things more fragile. And particularly with the hyperscalers and these very large companies that are spending hundreds of billions of dollars, if they're all depending on one another for revenues, and then it turns out one of them either goes bankrupt or their AI play doesn't work out as well, so they reduce their demand, that's going to unwind that ring of financing much quicker, and so could lead to quicker collapse. It's also sometimes can be a little harder and less transparent to even understand where the investments are, how they're made, and who has exposure to who. So, for example, Oracle is relying a lot on this revenue that's going to occur in the future from different sources, particularly OpenAI. OpenAI is largely at the center of these circular financing schemes. If OpenAI doesn't come through on that, then again, Oracle is going to be in trouble very fast because 2/3 of their anticipated future revenue is going to be from a singular firm. And then if that comes undone, then the whole system, not the whole system, but to the extent there's a bubble, it'll unwind much quicker.
Magnus, is that a concern?
I think it's
or not big enough piece of the action.
I think that it's definitely something you need to take into consideration when you're valuing a firm, right? And these contracts have been talked about quite openly, right? So you can build a pretty clear view on kind of who's investing into who and how that's getting into revenue. And I think you need, as an investor, to take that into consideration when you're valuing a company and the risk profile of that going forward, right? So I agree, it's something that one should look at, and it's something that should be transparent and should get into evaluation consideration. Another point on this, which I also agree on, is that Ryan didn't really say that, but I think that there's a tremendous amount of market reaction now to these contracts being signed, right? For example, you'll have like a chip company signing like a $20 billion deal with OpenAI, and suddenly their stock price goes up 20%, and you generate billions of dollars in value just by this announcement. I think as a venture capitalist, like these types of things are a little bit kind of strange to us because the fundamentals haven't really changed, right? With such an announcement, sure, like there's a partnership and there's future contracts being negotiated, but in the end, like it doesn't give a technological edge to that company, and they still need to deliver and compete against the other ones. So I think as an investor, what you really need to look at as you're thinking about that destruction and that noise, which you get more of in this large platform shift, is going back to the fundamentals when you invest. Like, do you believe these guys are creating a product that will really fundamentally change a big part of the world or the business environment? Do you believe you're backing the best teams in the world? Do they have incredible leadership? And really go down into the fundamentals of investing. So I think here we're getting a little bit more into kind of the details of differences between companies and how you think about investing than really whether we're in a bubble or not.
All right. We've had a number of people who have been listening to the conversation that you've been having. They are subject matter experts who think about and write about this topic, and they're going to join us now and ask some questions. And the first person I would like to bring in is Sebastian Malaby. Sebastian has a new book out on March 31st. It's about AI. It's titled The Infinity Machine Demis Hassabis, Deep Mind, and the Quest for Superintelligence. Sebastian, thanks so much for listening into the conversation, and thanks for joining us. What would you like to ask our debaters?
Well, thanks. Great to be here. I want to start with a sort of obvious point, which is that, a bubble is something that bursts. You've got to actually see the price collapse, then you really know it's a bubble. And therefore, the capital stack of the companies that are engaged in AI strikes me as super important to this debate, because what we see, and I think Ryan made this point as well, you have these hyperscalers, whether it's Google or Microsoft or Meta, or for that matter, the Elon Musk, XAI empire. And they're mostly attached to enormous revenue streams from something else. So Google can finance all these crazy big investments into AI from its legacy businesses, search, advertising. Those are still kicking off a lot of money. And so it strikes me that is not going to collapse, right? Because they've just got so much money coming in that they can pay for this out of pocket. And to that extent, the same would not be true of OpenAI, obviously. They don't have a deep-pocketed parent behind them, although they do have lots of money coming in from Microsoft originally, and then more recently Amazon. And so those are deep-pocketed backers. But what I'd like to ask Ryan, I guess, is, in your mind, if something, is a huge investment, it's a bit unclear whether it will pay off, but it's not going to collapse in the sense of, the stock price of Google, going down by 50%. Is that properly regarded as a bubble, or is that maybe just an investment mistake by a big company?
Yeah, sure. And if I can start by plugging two of Sebastian's previous books, More Money Than God and his wonderful biography on Alan Greenspan, both of which have been very influential in my thinking about financial markets. So thank you for the question, Sebastian. I think in the context of is it a bubble, actually, the capital stack, especially for the amount of money we're talking about, is actually irrelevant. And what I mean by the following is, it's relevant to the question of, are these firms going to go insolvent if the AI busts, or if AI doesn't pay off like we're hoping it does? So in that case, no, I don't think any of the big hyperscalers that have all this money, for example, Google or Amazon or Meta or any of these firms, are going to go bust because they have plenty of cash to burn through. But their share prices right now are expecting a return on all of that money they're not spending. And this is a very basic thing from corporate finance. It's more or less where we say corporate finance starts, is a very famous paper from the 1950s, Modigliani and Miller. And what that paper says is equity, debt, it doesn't really matter how a firm is financed based off its value. What its value depends on is the future stream of profits. So again, we know this is wrong in certain aspects. It's better to issue debt than it is to go raise shares, and it's better to finance things out of retained earnings or profits, as these firms have been doing. But at the end of the day, if they're making a huge bet on AI to pay off and that doesn't materialize, that's money that's not being returned to shareholders in the forms of dividends or buybacks or whatever method they're doing this capital repatriation. So I don't actually think, in terms of are we in a bubble or not, the capital stack matters that much.
Magnus, you want to respond to that question as well?
Yeah, so first of all, I want to echo Ryan and say, Sebastian, I really look forward to reading your new book. I think the story is very relevant, and sorry to go on a bit of a tangent there, but as AI kind of grows all over the world, obviously a lot of countries are thinking about their position within this space and the opportunities in Europe, in the Middle East, in Asia, in Africa. Like how do you, in this, because a lot of these regions have lost out in the last platform shifts, right? If you think about the biggest companies within the internet right now, within computers, within mobile, within cloud, they're either all in the US and the second biggest ones are in China. And everyone is thinking about how at this time around, can you build some of those truly global leading companies within your area? And obviously with DeepMind, you had that being created in the UK, but they couldn't access deep enough capital markets to keep that company within the UK and independent. That's one of the reasons why they went to Google, because that's the way they could execute on their vision. And I think this brings me back to the capital stack question, which is, I think in a scenario, if you look at the founders we are backing, the most ambitious ones, the ones who are truly building the most exciting technology that will impact the world the most, they really need to access sizable capital stacks to succeed, right? Because typically the more of a moonshot these companies are, the more capital they need to raise before they're profitable and they deliver a real cash flow. So I think global institutions, family offices, former founders who've been very successful, VCs play a very important role to ensure that they get that in place so that they can get over the hurdle they need to be to create real scale. And I think governments really need to think about this, particularly with outside of the US and China, where you still have kind of capital markets that are not sufficient to deliver that capital stack to companies to get to that level. And I think the DeepMind story is an example of that. There's probably many other reasons why they sold to Google, but that was definitely one of them.
Yeah, and I just
Sebastian, thank you so much.
Oh, can I just add to that, John?
Sure. Yeah, very briefly, because we have a few more people to come in.
No, I just want to say I fully agree with everything Magnus says. Like, access to capital is important for building, and then also the extent to which there's debt would matter for how big of the burst it is. So if you have a lot, if everything's equity financed, the firms don't go bankrupt and then have to unwind everything. So I just wanted to append that to my answer as well.
Thank you. And Sebastian, I want to thank you very much for your question. Thanks for joining us.
Great to be here.
I want to welcome someone else now. This is Christine G. She's a big tech reporter at MarketWatch, extensively covering AI. Christine, thank you for joining us in the program, and please come on in with your question.
Yeah, thanks for having me. So my question is about we've seen some very high profile layoffs across big tech firms recently, whether it was Block or there's rumors that Meta is cutting up to 20% of their workforce. So is that a sign that AI is actually adding value, boosting productivity, that these companies don't need to employ as many people anymore? Or is that are we AI washing some of these layoffs that companies are planning to do anyway? And as a follow-up to that,
can you I actually do want your follow-up, but I'd like to separate it so that we can keep the questions in order, if you don't mind. Can you stand by for that?
Awesome,
as
sure.
we go with your first one? Thank you. Who would you like to direct your question to first of all?
I'd like to direct it to Magnus first.
Okay, thanks, Magnus.
Hey, thank you for the question. I think it's great. I'm a firm believer that a lot of these biggest companies in the world just hired way too many people the last decade. And to a certain extent, those efficiencies that are currently being driven is efficiencies you could have taken out with or without AI. So I do think there's a certain level of AI washing going on. When that's said, AI is driving real efficiencies, and you will see people becoming more productive. And sometimes that will lead to more revenue growth, and you will actually end up hiring more people that will be very effective. Like if you have a lot of effective people and they are generating good returns and you can continue to grow, then you will end up hiring more people. But in many circumstances now, since most of the processes for AI are being implemented is to drive efficiency, we haven't really gotten into that growth part and building new products yet for most businesses. It's more having an effect where you need less people in certain parts of the business, right? So I think long term this will go both ways. In the short term, I do think that a lot of this is just restructuring to levels where people should have been a long time ago, and then part of it is efficiency increases.
Ryan, I'd love to see what you do with that question.
Yeah, I largely agree with Magnus that I think a lot of this, particularly in tech, is just they overhired roughly right after the pandemic, and now there's a bit of a correction that broadly happened. Also agree there's certainly efficiencies that are occurring. Now, if you look at, for example, the number of job postings or job openings for software engineers and hiring, those have actually increased since the release of ChatGPT. So clearly it's not just that it's replacing all the software engineers and everybody else who's AI exposed recently. So to that end, I think it is probably some AI washing. Again, I'm not certain about what the right mix of AI washing versus to these efficiency gains are. The other thing to keep in mind, too, whenever you see these tech layoff numbers, Box, I think they laid off maybe 6,000 people or 8,000 people. There's 1.5 to 2 million people every month, even in a good economy, that get laid off. So these are very, very small fractions of the total amount of layoffs that happen in the economy in every single month. So I think over-torquing on one announcement or another isn't really dispositive for what's going on in either direction.
So, Christine, thank you for your patience on holding off on the second question. I wanted us to have the first question still in mind when we got to it. So let's come in with your second question, please.
Yeah. So on the one end of the spectrum, right? Because so much of the stock market and so much money has been put into AI, if it fails, there'll be a very big impact across people's 401ks, the S&P in general. But on the other hand, we saw last month that a research report came out from Citrini that was detailing a scenario where AI was very successful and it automated a lot of the white collar jobs, and consumption decreased as a result because people aren't getting money to participate in the economy. So is there a scenario where the pendulum swings too far on the other side and AI gets too good at taking people's jobs?
I think, the Citrini report, this report that talked about potentially AI getting too good, was a very good thought experiment, and I thought well written. On the other hand, economists like myself have pointed out there's a lot of issues with the economic reasoning. For example, you wouldn't keep building supply of these different AI products if there was no demand, and there's assumed that the government just stands back and does absolutely nothing, both in terms of fiscal policy and in terms of any sort of AI regulation. So I don't think AI is going to get just so good everybody's going to be out of a job, like the leaders of these companies have somewhat bizarrely been arguing as a feature of AI, that it's going to take everybody's jobs. But at the same time, there's certainly going to be displacement just by virtue of having a technological shock like both Magnus and I think it will be. Then the question is, for the government, how do you catch people as they fall? And the answer to that is pretty simple. You just have a very robust and wide social safety net.
Magnus?
Yeah, so assuming that AI becomes as good as you described, Christine, assuming that's what ends up happening, and I think there are that would have led to pretty incredible productivity increases and pretty incredible discovery of ability to solve new problems and drive economic growth. So if AI becomes that good, we're probably in an environment of huge economic abundance. And I think huge economic abundance can be treated in different ways, right? You see in good way to treat that and bad ways to treat that. Like, for example, Venezuela, one of the resource richest countries in the world, or Nigeria, one of the resource richest countries in the world. And if you look at how that wealth has been distributed in those countries and versus, for example, Norway, where I come from, right? So there, I think government, as we move towards that world of abundance, which I think that we will move towards, there I think government will play a very important role. Norway is now one of the richest countries in the world, and to a certain extent, people can choose to work or not to work. But inequality is actually much less than in some of the poorest countries in the world, right? So you can move towards such a world where people are better off, or you can move towards such a world where inequality is higher and people are worse off, right? And I think here actually government plays a very, very important role in terms of economic policy and so on. Now, in terms of the people out there who are a bit worried about their job, right? What I would really recommend, and I think we're such an early stage of AI right now, is I really recommend people to go out there and learn it properly. Really, really learn it. And we're in this incredible environment right now where you don't need to hire a teacher. AI in itself can be your teacher. So I really recommend everyone in the world should, if they have access to a feature phone or a phone or internet or better a computer, set off a few hours a day to go deep on AI and learn how that can make you better, how it can make your business better, how it can make you more efficient at work. And I think the people who do that will be very well positioned to benefit from this platform shift instead of falling behind. And for the first time ever, unless you have access to a phone, there's really no excuse not to be part of this technological shift. and not go the other direction.
Christine, thank you for your questions, but I have a question for you because you're out there and you're reporting on this topic and in touch with so many people. This question that we're examining about whether there's an AI bubble or not, do you experience more optimism and full speed ahead, or are you hearing the kinds of concerns that Ryan is talking about? Are there people saying it's just getting ahead of itself?
I think it depends on who you ask. Because, as Ryan mentioned, some of these CEOs of AI companies have kind of marketed AI as like a tool of like mass displacement. I think there is a lot of jitter. There are a lot of jitters among the average person's like interpretation of AI. And then, as we talked about the circular financing that was occurring in the fall, the NVIDIA, OpenAI, they were inking like several like multi-billion-dollar deals, and the anxieties were really rising. But unfortunately, it is like a wait-and-see game. There's just not enough information out there. So, as companies have reported, Oracle, for example, last quarter they were able to show that they were converting a lot of their contracted those commitments into revenue, so that gave investors a little sigh of relief. But there's a very slow, long trail of breadcrumbs and no definitive answers. So hence why we are having this debate.
Yeah, well, thank you very much, and thanks for joining us. I'm delighted to welcome in Tom Bilyeu, whose show I am actually a fan of. Tom, thanks for joining us. I describe your show to people as a show about thinking well.
Wow!
I've been following for a long time, and a lot of my early understanding of AI came from listening to your conversation. So I'm delighted to have you in our program.
I'm honored to be here. Thank you so much.
You have a question for our debaters?
I do. So I look at the stock market maybe in a slightly different way that might be a little controversial, but to me, it's all about vibes. It's extreme speculation, largely driven by the need to hide from inflation. And so when I look at the valuations that we're seeing now, even before the wave of IPOs, is basically a marker of how people are feeling about what's coming. I don't think people are betting on what they see today, Magnus. So you talk a lot about that. And I think that you're right. I think this technology is going to change everything. I couldn't be more excited. I talk about this endlessly. It's going to be so radically transformational. But even my own thinking is largely predicated on what I think is going to happen versus what has already happened. And so I wonder if you strip out all of the juice that people are putting on these valuations based on, say, the prediction that it's going to bring about AGI, if you were to pull that bet that AGI is actually going to happen away and leave people with, let's say, an asymptoted AI where it's what it does today and that's all it's ever going to be, would we still be able to justify the extreme valuations that we're seeing now, or are they all predicated on this sort of sci-fi AGI future? And that's for both of you guys, but Magnus, if you want to start, please.
Yeah, thanks a lot. Also a big fan of your show, so great to see you here. So I think there the devil is really in the detail, right? So first of all, from an investment perspective, I think it's insanely important to have a portfolio view on it, and I think speculating in highly liquid stocks should be a proportion of your portfolio, and a proportion of that should be AI. And within AI, we'll need to be selective, I think, in terms of what one back and what one doesn't back. I do think what is interesting here, and we spoke a little bit about it earlier, is that there are a number of companies that are generating real revenue at a level that we've never seen before, and their demand is so high that they really can't not deliver on it, right? And that's not only NVIDIA and the data center players and so on. Like, even if you look at, we're just talking to the Cloud Workspace guys the other day, right? It's like, you know, they're almost like happy to turn away clients because they're so busy, right? So it's like, so there's this tremendous opportunity to grow within existing demand. And then I think the other thing that is interesting, which is perhaps like a perspective we can come with, because we are active all over the world, right? We invest all over Asia, Australia, Africa, Middle East, Europe, South America, and also in the US, where you have some of those biggest outcomes. And it's kind of real all over the world, right? We booked this incredible company, Peak AI, out of Germany. It's probably the fastest growing German company ever in terms of revenue generation. They're doing geo, they're serving businesses all over the world. We backed some amazing founders out of Singapore. who are replacing process engineers with AI, and they sold into this massive business all over the world, and they're already in factories. We have like the perplexity of Korea called Written. So we have Lovable out of Stockholm, like tiny town, which I think like 15% of all the websites in the world now are built on their platform, right? So it's not, this reality doesn't only rest with a few of the big players that everyone knows from the US, but it's happening everywhere. And it's real revenue, real productivity gains, and real efficiency being driven. And that's very, very exciting to see, I think, because normally these things have kind of taken a little bit longer time to pull out globally. But again, right, the devil is in the details. I think one needs to build the right portfolio, and then within AI make the right decisions, right? Because as I said earlier, like there will be losers.
There's one part of my question, if I could, that I'm hoping you guys will both contend with, which is the idea that the valuations that people get once you start IPOing. So forget the private channel where everything's happening right now, but imagine an IPO where the average person, do you think they're going to pay a price based on what AI can do today? Or do you think they're imagining a future where a sci-fi AGI type thing comes into place? And I think that's the important question, not just because I think everybody at the retail level is in sci-fi mode, but that's going to set them up for frustration when the sci-fi element of AI takes longer than they're expecting. And that's why, even though no one could be more excited about the day-to-day realities of AI than myself, but I still think a bubble bursting is inevitable because of the discrepancy between what I think the average retail investor is going to expect. They're going to plonk down big dollars at IPO, then they're going to expect this rapid return on that investment. And I don't think they're going to get it because their vision of what AI is going to become involves AGI.
Tom, I have to let your question stand as a comment because we're hitting time and we have one more speaker to come through.
Fair enough.
But I thought it was a fascinating question that had plenty of information in it. So, maybe afterwards we can chat about it, but I apologize. I have to jump in to bring him in. Thank you so much for understanding. And now I want to welcome Alex Reisner, who's a staff writer at The Atlantic. Thanks for your patience in waiting, Alex, and please come in with your question.
Yeah, thanks for having me. Both debaters have mentioned the huge expenses that these AI companies have. And back in November, we had Sarah Fryer, the CFO of OpenAI, make a comment publicly that, the company has these massive chip expenses. They're going to have even more expenses in a few years when they need to buy new chips. And perhaps a government backstop was the word she used, could be helpful. And I guess I'm wondering, it's not entirely clear what she meant by that, but I think I'm wondering what role the government and taxpayer money could or should play in protecting these companies from a collapse.
Yeah,
this is for either of you.
Yeah, I can take this one first. I think she did, in fairness to her, I think eventually walked that back and said, no, I wasn't suggesting a bailout. With that being said, I think the role for the companies themselves is pretty much zero. There's no reason why the government, especially in advance, should say for a private enterprise, we're going to bail you out if things go wrong. I mean, maybe you could make some sort of national security arguments, but there's several of these firms, so it's not like everything's depending on one of them in particular, and that would create all kinds of moral hazard problems, meaning if the firm knows it's going to get a bailout in the future, it's going to do a lot more risky and potentially unproductive things today. Now, with that being said, there's obviously a very big role for the government to play in the event that a bubble does pop. And this is something that I just mentioned before. That's having a very robust social safety net. So ensuring that people who lose their jobs or are out of work have housing, have food, have some sort of income. And that's important, obviously, morally, just to make sure that people are not suffering in squalor. But it's also important for the economy, too, to make sure that there's some baseline level of demand. Now, with that being said, this is where I think the timing is very important. So, for example, if the bubble burst in the next year or two, the administration in charge of handling that is obviously going to be the current one, the Trump administration. And given we're recording this on March 17th, just a little over 2 weeks after the Iran war started, seeing how that administration has responded to this self-inflicted crisis, I think is pretty concerning to think about if we did have a bubble pop and we needed that fast, quick, and very smart support from the government.
Magnus?
So I think in the US you have this tremendous situation where most kind of wealthy individuals, most family offices, most large institutions, whether it's a pension fund or it's an endowment, they're taking a proportion of their capital and then they're investing it into innovation, and that has been happening for decades. So you have this very well functioning capital markets, which just means that this capital will flow towards the biggest opportunities within innovation. And if there's a great value creation opportunity, they will be able to access the capital that they need. I think in the rest of the world, there are certain countries and regions where that just doesn't happen yet, right? So it's like some of the family offices and some of the companies, they're not really allocating part of their budgets. The pension funds they allocated zero to venture capital. They've been talking about it for many years, but they don't do it. So I think there are parts of the world where government will need to play a role in terms of enabling capital flow into innovation. And I think that's very important. Otherwise, you're going to fall behind. And if you fall behind in this platform shift, it's going to come, I think, at a pretty huge cost in terms of the GDP per capita in those countries, right? So I think in certain parts of the world, the government will play a big role there in terms of ensuring that there is access to capital. And this is more around, I think, loosening some regulation in terms of risk management and driving the right behavior than really hard forcing. But in the US, I really don't think you need so. Like the capital markets here are so efficient that if there's a real opportunity there, the money will be available. And if they're spending way too much money and not generating enough revenue, then the company will not succeed. So that's how I look at it.
All right. Well, thank you. And Alex, thank you for your question. We have to jump to our closing round. And Alex, I appreciate your staying through and bringing that question to our debaters. But now we move on to our closing round. And that's where each debater has a last chance to persuade you that the AI bubble will burst, or in this case, that it won't. And in fact, that there isn't an AI bubble. But Ryan, you're up first for your closing statement, please.
Great. Well, thank you both again. I've really had a good time doing this. And I want to note, too, that while I am arguing that we are in an AI bubble and I do believe it will pop, I do not think anybody should go out and immediately sell all their shares or anything like this. You should consult with a financial advisor. If you're in your 30s, for example, even if prices go down, most likely they'll come back up eventually. And if you're in your 70s, you should already be more or less out of stocks and in bonds. So with that caveat, Isaac Newton was involved in a bubble in the 1700s in the South China Company. And when the bubble crashed and he lost a lot of money, he's reported to have said that he can model the motions of the heavens, but not the insanity of people. Now, are markets and people currently right now insane? I don't think so, no. But I do think there's a really good framework which we can have. There's a 2009 paper by two economists at the University of Chicago. And what they say is effectively the following, that with the new technology, we gradually learn about its usefulness. And so initially, whenever everybody thinks it's going to be a revolutionary and world-changing technology, people are very hopeful, and you can see that reflected in very high valuations. But as they learn about how useful it is, those valuations start to come down. So afterwards, you see something that looks like a bubble, or looks like a bubble that occurred, and then eventually pops. And we've seen this throughout history of people getting very excited about new technological revolutions, and then them ultimately having a bubble, but still to make a profound impact. Now, Magnus has made some great points about these companies having lots of revenue, having lots of growth. But for listeners at home, the question I would ask is, look at the amount of investment that's being made into that. Hundreds of billions of dollars by single companies. And do you think the amount of revenue growth and the amount of profits that are going to accrue to firms is going to be able to match that? And if the answer is probably not in the next 5, 7, maybe 10 years, then I think we're in a bubble.
Thank you very much. Nice finishing point to bring it around to the title again one more time. But that leaves it to you, Magnus. You get the last word in this debate. Your closing statement, please.
Excellent. This has been great, and very happy we're also agreeing on a lot of things. I believe, just to make it clear, I do believe there are overvalued companies out there. There are specific areas in which valuations have gone very high. And I think as an investor, one needs to be careful where you put your capital. At the same time, I really believe we're not at the bubble as a whole in the industry. I think we're at the very, very beginning. And I went through a number of arguments and probably not going to repeat them at the end in terms of why I think so. But we are at the biggest technological platform shift the world has ever seen. The potential of this technology, we haven't even tapped into. I spoke a little bit about healthcare earlier and everything we can do there, which is the fastest growing cost bucket in the world. If you look at scientific discovery, if you believe there's climate change in the world and you need new sources of power, if you're going to resolve access to resources, I think AI will play an incredibly important role. If you look at productivity growth in the world, the last few decades, actually a lot of productivity growth has not really been captured in making lives better for people because energy prices and other prices have just gone up. I think AI will enable us to increase productivity much faster than cost. And when that happens, the people who benefit the most from that are typically the people who are the worst off in society. And in healthcare, we didn't even get to that. But part of it is solving a lot of new diseases and making things more efficient. But at the same time, there are hundreds of millions of people in the world who don't have basic access to healthcare. And AI will enable that, the same within education. So we're just getting started. We're not in the bubble. This is the most exciting time to be alive in human history. I'm very happy to be here.
Another nice finish, and I've complimented both of you because what you did in this debate is what we like to demonstrate can be done, which is to disagree in a way that is respectful and civil, even though you really, really do disagree. And you made our point, and I really appreciate both of you for doing that. So I want to thank you for that. I also want to thank those who participated by asking questions, Christine and Tom and Sebastian and Alex. Thank you. You got us to more interesting places. But again, mostly to the two of you for the way that you conducted yourselves in this debate. It was excellent to have you on. Thank you so much.
Thank you, John. Thank you, Magnus.
Thank you.